We would like to share 3 key messages with you this week. First, we note positive momentum in markets. Next, we highlight the continuation of strong economic data. And finally, we take a look at why emerging market debt has performed well so far this year. Within markets, we see positive momentum building across Europe and the US. This has been supported by a more stable political outlook in Europe after Macron won the final round of the French presidential election. The result fed through to equity markets as the CAC 40 and the DAX registered positive moves. In the US, equities have also continued to move higher, with the technology-heavy NASDAQ touching record high levels as tech companies reported impressive earnings growth. We highlighted this in our investment update 2 weeks ago. Again, we maintain a positive outlook for equities, particularly in Europe and Japan. In the macro arena last week, the Bank of England kept the interest rate at 0.25%, as we had expected. The short-term forecast for GDP growth, however, was revised downwards, and as a result, sterling weakened somewhat. Across in emerging markets, Brazil reported an inflation rate of 4%, which is in fact the lowest seen since 2007. This is in spite of numerous interest rate cuts, which have reduced the policy rate from 14.15% to 11.15% over the past 6 months. This does, however, highlight how much higher local rates are in emerging markets versus those available in developed markets, and is one of the reasons why we like emerging market debt. Staying with emerging markets, we'd like to provide a quick update on emerging market debt. Let's take a look at how this asset class has performed versus other types of debt so far this year. Our preferred emerging market local currency debt has generated returns in excess of low-risk US Treasuries, as well as relatively more risky US high-yield bonds. So why have emerging markets done well in 2017? There are 2 broad reasons. Firstly, global economic data has continued to broadly improve, and we see this as a positive indication for both developed and emerging markets alike. Secondly, when Trump was elected US president, he had proposed a number of policies which would be negative for emerging markets, such as the implementation of some fairly severe trade protectionist measures. Since then, however, his ability and his willingness to implement these policies have come into question, and as a result, the concerns regarding emerging markets have been somewhat alleviated. In line with our investment principles, we are value-orientated investors, and in this vein, we continue to see emerging market debt as an attractive return-generating opportunity.